Do we change our outlook on the equity markets and on credit markets, Tony, after this, or do we go back to sort of what used to be the normal?
No, it should have been changed before this. I mean, that's the problem, is that, the problem with people would like to blame the ETNs, and there's some volatility ETNs that are apparently creating this increase in downside. But again, that was born out of complacency from very low volatility. You had historically low volatility over the last year. You had one of the smallest drawdowns in the history of the S&P 500, maximum drawdowns throughout the year. So you're in this environment where people were just kind of, it was sentiment that created the problem, and then you had a vehicle in the ETN that allowed for the execution of that problem. But ultimately, what we do, and the one thing we know, is that the market correlates to the direction of earnings, full stop. As long as that direction of earnings is going to remain positive, you should be long the market. Historically, the only thing that changes that is an inversion of the yield curve, and for the viewers, that's when short-term interest rates are higher than long-term interest rates. When that shuts down credit, and you end up in a recession. So we're still running probably years away from that, at least 18 to 24 months away from that. And therefore, we're buying the volatility, or buying the opportunity that the volatility is creating.
Tony, have the markets woken up from their slumber now? I mean, you could say to a certain extent that the market was in a Trump slumber, a Fed slumber, just waiting for things to happen, and being content that the volatility and so forth just wasn't there. Are we awake now? Is this it? Are the markets interesting again?
No, the markets are, again, until you really can have an identifiable recession. Think about this. Even believe it or not, I was around in the crash of '87. So even back then, the crash of '87, that wasn't the peak of the market. 1987 wasn't the peak of the market. 1989 was, after you shut down credit once you inverted the curve and ended up with the S&L crisis in a recession. So the long-term view that we have with our institutional clients and our wealth management clients outside the U.S. is that until you get that recession, we use high volatility periods as opportunities. Now, where we've changed in 2018 versus last year is we don't necessarily believe that you had to buy that next tick higher as the market was racing higher. You want to wait for these periods of volatility. The problem is they seem like so much more when you get them. But again, we think that as long as the fundamentals remain in place, you want to buy it.